Hello students, in today's video, I will try to show you how to calculate cash flow from operating activities when a vertical income statement is provided to us. So let me show you the question. Now this is the question that we have. This is an income statement for the year ended 31st December 2018, and they have given us a vertical income statement. So let me just read out the question. Now here we have revenue from operation, which is given to us in this statement is 15 lakh. The other incomes are not there. So the total revenue is 15 lakh. Now we also have expenses. So the first expenses which is shown here is cost of material consumed, which is 12 lakh. Then depreciation is 45,000. Other expenses, there is a note to account. So we will refer to the note to account for preparing the cash flow statement. If we look at the notes to account, we see that the other expenses are related to administrative expenses and selling expenses, which is 80,000 and 60,000 respectively, and they together form 1,40,000. So the other expenses is 1,40,000, and while preparing the cash flow statement, since the note to account is provided to us, we will take the information from the notes to account and we will not take the information from the main income statement. Now, if we see the total expenses in this question, it is 13,85,000. Now, when we deduct 13,85,000 from the total revenue, we get a profit of 1,15,000, which is before tax. This profit is before tax, and the profit after tax, the provision for tax is 20,000. So after deducting the provision for tax of 20,000, we get a profit which we call it as profit after tax is 95,000. I hope you have understood this question, and with the help of this question we have to show the cash flow from operating activities. In this question they have also provided us some additional information, so let us see the additional information. Now, in this additional information, we can see there are two dates, that is on 31st December 2018, which is the current year's ending, and 31st December 2017, which is the previous year's ending. Now, this will be the opening value. This column which is given to us will show us the opening values of the various items. So the opening values will be presented on 31st December 2017, and the closing values for the current year will be provided in the date which is given to us as 31st December 2018. So the items are like, we have debtors, which is a current asset, we have bills receivable, which is a current asset, we have bills payable, which is a current liability, we have creditors, which is a current liability, outstanding expense is a current liability, prepaid expense is a current asset, and inventories are current assets. So we will discuss about this later when we will prepare the cash flow from operating activities. So let me show you how to prepare the cash flow statement where we will show the cash flow from operating activities. Now if we look at our question, we see that our net profit after tax is 95,000. So we will start our statement with this net profit after tax, which is 95,000. So we will write, before that we will write cash flow statement for the year ending 31st December 2018. Then we will have two amount columns and the particulars column. Then we write A, cash flow from operating activities, and then we write net profit. This is net profit after tax, which is 95,000. Now if we look at our question, we find that the provision for tax in this question is 20,000. Since they have not given us the payment for tax and provision for tax separately in this question, we will assume this 20,000 as provision for tax, and this 20,000 is also the payment for tax which is made during the year. So whatever the provision for tax made during the year, the same amount is also made as payment for tax during the year. So this 20,000 will be taken as provision for tax as well as payment for tax. So we will add this provision for tax to the net profit after tax, which is 95,000, and then this will give us our net profit before tax. In my previous video, I have explained in details how to calculate the net profit before tax. So if you want to understand, you can look at my previous video where I have explained how to calculate the net profit before tax. So here in this question we have only one item, that is provision for tax. So we are going to add this to the net profit after tax, which is 95,000, to get our net profit before tax. So our net profit before tax in this question will be 1,15,000. Now our next step is to calculate the operating profit before working capital changes. Now in order to calculate our operating profit, we have to analyze our income statement again. Now if you look at our income statement, the total revenue is 15 lakh and our total expenses is 13 lakh 85,000. Now if we deduct the total expenses from the total revenue, we get a profit of 1,15,000, and this is the profit before tax. In our cash flow statement, what we have done is we took the net profit after tax and we added a tax paid of 20,000, and we have arrived at this 1,15,000, which is the profit before tax. Now our next step is to calculate the operating profit. Now let me show you our income statement in a simplified way so that it will be easier for me to explain you. Now this is the income statement in a simplified way. I'm just showing you. Now we have the revenue from operation, which is 15 lakh, and we have the different expenses, different types of expenses, like the cost of materials consumed. Then we have depreciation, we have administrative expenses, and we have selling expenses. When all these expenses were deducted from the total revenue, then the profit was 1,15,000. And this profit is the profit before tax. Now, in order to calculate the operating profit, we have to consider two things. The items that we are going to take from our income statement should be, number one, it should be operating items, and number two, they should be cash or cash equivalent items. So we will consider only those items which are operating in nature, and they should be cash or cash equivalent items. Now, if we look at our statement, we can see on the income side, the revenue from operation is an operating item and it is a cash item. And if you look at the expenses side, we have cost of materials consumed is an operating item and it is a cash item. On the other hand, if we look at depreciation, it is an operating item, but it is a non-cash item because we do not pay any cash for depreciation. Then administrative expense is an operating item and it is a cash item, and selling expense is a cash item and it's an operating item also. So in order to calculate the operating profit, we should understand here that when we prepare the cash flow statement, we prepare in the indirect way. Here we are not going to show the details of all the inflows and outflows of cash from operating items. Like for example, we are not going to show revenue from operations, we are not going to show cost of materials consumed, we are not going to show administrative expenses and selling expenses. We will just adjust the net profit. Now I will show you both the ways, the simple way and also the indirect method, which we follow in our in the cash flow statement. So let me show you the simple way of calculating. Now when we calculate in the simple way, what we do it is we show those items which are operating in nature and they are purely cash. For example, here when we show it in the simple way, we will show that there will be an inflow of cash from revenue from operations 15 lakh, and we will take cost of materials consumed as an outflow of 12 lakh. We will take administrative expense of 80,000 as an outflow of cash, and we will take selling expense 60,000 as an outflow of cash. We will not take depreciation because there is no actual cash outflow from depreciation. So if we do that, the result will be like this. Now revenue from operation 15 lakh, cost of materials consumed 12 lakh, administrative expense 80,000 and selling expenses 60,000. When all these expenses are deducted from the total revenues, then we get 1,60,000. This is our operating profit, and it is the operating profit before working capital changes. So this is in the simple way. Okay, now in the cash flow statement, we do not follow this way of calculating the operating profit. We actually follow the indirect method. Now in the indirect way, what we do it is we simply adjust the net profit. Now to make you understand, first of all we have to understand that this net profit of 1,15,000 is an effect from the revenue from operation and all the expenses which have been deducted from the revenue. So this profit has come from the the expenses, the total expenses which were deducted from the total revenues. So each and every item has an effect on this net profit. Now, in order to calculate the operating profit, we will just adjust this net profit of 1,15,000. That is, if we look at our expenses side, we can see the items. We will just take those items which are actually non-cash and non-operating, which has affected our profit. So we will adjust it. If it is on the expenses side, if such items are there, we are going to add them, and if such items are there on the expenses on the income side, then we are going to subtract them. For example, if we look at our expenses side, we see depreciation of 45,000. It has affected our net profit of 1,15,000. It has actually decreased our profit by 45,000. So what we are going to do it is, we are going to add back this 45,000 to the net profit, because it has decreased the profit by 45,000. Since depreciation is an operating but it is a non-cash item, and if we do not adjust this, it will mean that there is an outflow of 45,000. So there is no actual cash outflow of 45,000. So we are going to add this back to the net profit in order to calculate the operating profit. So what we have to remember here is that in the indirect method, we do not show all the details of all the cash items or the operating items. We just adjust the net profit. That is, by adding back the non-cash or non-operating items. If they are on the expenses side, we add them back, and if those items are there on the income side, we subtract them back, because if it is on the income side, they will increase the profit, and if they are on the expenditure side, they will decrease the profit. So if it decreases the profit, we'll add, and if it increases the profit, we will subtract. So in our question, if we calculate in the indirect way, first of all, we'll take the net profit of 1,15,000. Then what we will do it is, we will just simply take the non-cash or non-operating items from the statement. So here we have depreciation, which appears on the expenses side. So we are going to add this back to the profit, because it has decreased the profit by 45,000. So when we add this item of 45,000, we get 1,60,000, which is our operating profit, and it is the operating profit before working capital changes. So let me show you a simple formula to calculate the operating profit in the indirect method. Now, in order to calculate in the indirect method, first of all, we get the net profit before tax. Now, this profit will be adjusted by adding back all the non-operating or the non-cash expenses, which may appear on the expenses side of our income statement in the question. For example, these items can be like depreciation, then we have goodwill written off, we have preliminary expenses written off, loss on sale of assets, interest paid. These items some are like they are non-operating items, some are non-cash items. For example, depreciation is an operating item, but it is a non-cash item. Goodwill written off is a non-cash item. Preliminary expenses written off is a non-cash item. Loss on sale of asset is a non-operating item. Interest paid is a non-operating item. Now, these items will actually decrease the profit. So in order to adjust our net profit, what we do it is, we add them back to the net profit. Similarly, if on the income side, if we have any non-operating or non-cash incomes, which will actually increase the profit, we are going to deduct it. So for example, the examples are like profit on sale of assets, interest received, dividend received. Now, profit on sale of assets, interest received, and dividend received are all non-operating items. This will increase the profit. So what we will do it, in order to calculate the operating profit, we are going to deduct it, because they are increasing the profit. After we do this, and we adjust it with the net profit, then what the amount that will come will be our operating profit or operating loss, and this will be the operating profit or operating loss before working capital changes. I hope by now you have understood how to calculate the operating profit before working capital changes in the indirect method. Now let me show you how we show the calculation of operating profit in our cash flow statement. Now, as I have already showed you, that when we look at our income statement for calculating the operating profit, we always try to see if there is any item which are of non-cash or non-operating items in the income statement, both on the revenue side as well as on the expenses side. Now in our question, as we already know that depreciation is the only item which is a non-cash item, so we will add this to our net profit because it has decreased our net profit by 45,000. so this is how we show in our cash flow statement. First of all, we have already calculated net profit before tax 1,15,000. Now below that we write adjustments related to non-cash and non-operating activities. Then we add depreciation because depreciation is shown on the expenses side and it has decreased our profit by 45,000. So we add back to our profit and this will give us our operating profit before working capital changes. So our operating profit before working capital changes, as we have already calculated before also, now it is 1,60,000. That is after adding 45,000 to the net profit before tax, that is 1,15,000. So it gives us 1,60,000 and this is our operating profit. After we are done with the operating profit, the next step involved is the adjustments related to current assets and current liabilities. So we write the heading as adjustments related to current assets and current liabilities. Now let us look at our question. Let us see all the current assets and the current liabilities. So what the current assets and the current liabilities that we have in our question is, like, we have debtors, we have bills receivable, bills payable, creditors, outstanding expenses, prepaid expenses, and inventories. Now, as I have told you that this column and the date which is shown as 31st December 2017 shows the opening values of the items, and 31st December 2018 shows the closing values of the items for the year. Now, as I have already explained you in my previous video, that if the current asset increases in the value during the year, then we assume that it is an outflow of cash, and if the current asset decreases, then we assume that it is an inflow of cash. That is for current assets. And if it is current liabilities, then it is the opposite. If it is an increase, we assume that it is an inflow of cash, and if it is a decrease, then we assume that it is an outflow of cash. Now, keeping that in mind, we will show the adjustments related to current assets and current liabilities. Now, if we look at our current assets and current liabilities, this is how the picture is. If we look at debtors are current asset. So if we see that there is before the opening value was 50,000, now it is 45,000, so there is a decrease of 5,000. So this is an inflow of cash. Then we have bills receivable is a current asset. We can see before it was 4,000, now it is 6,000. There's a difference of 2,000 and it has increased by 2,000, so it is an outflow of cash. Then we have bills payable, which is a current liability. So we can see before it was 12,000, now it is 15,000. There's a difference of 3,000, so it has increased by 3,000, so it is an inflow of cash. Then if we look at creditors, before it was 35,000, now it is 40,000. There's a difference of 5,000, so we assume that there is an inflow of cash. Then before outstanding expenses, a current liability. Before it was 4,000, now it is 3,000. There's a decrease of 1,000, so we assume that there is an outflow of cash. Now prepaid expense is a current asset, so we can see before it was 1,000, now it is 1,500. There's a difference of 500, so it has increased by 500 rupees, so we assume that there is an outflow of cash. It's a current asset, so it's an outflow of cash. Now if you look at inventories, before it was 80,000, now it is 60,000. There's a decrease of 20,000. It's a current asset, so we assume that there is an inflow of cash because it has decreased. Now when we place all these differences in our cash flow statement, this is how it will appear. Now the items which will be added will be decrease in debtors, it's a current asset. Decrease in inventory is a current asset. Increase in creditor is a current liability. Increase in bills payable, it's a current liability. So we will add all these items to that means we are showing it as an inflow of cash. And then the items to be deducted, which will be shown as outflow of cash, will be increase in bills payable, increase in prepaid expenses, decrease in outstanding expenses, that is 2000, then 500, then 1000. After all the calculation, the balance or the final amount that we will get will be 29,500 as an inflow of cash after the net amount is calculated related to current assets and current liabilities. So the balance will be 29,500. Now this will be added to the operating profit before working capital changes, and if we do that, we will get an amount of 1,89,500, and this is the under this statement we write cash generated from operating activities before tax. So the amount of cash generated from operating activities before tax is 1,89,500. That is after adding the amount of 29,500 to the operating profit of 1,60,000. Now after this, we will try to see how much is the payment for tax. Now in this sum, as I've told you before also, that the provision for tax is 20,000. So in a sum, if the provision for tax and the payment for tax is not given separately, then in that case what we assume is whatever the provision is made during the year, that means in this case it is 20,000, the same amount we assume that the payment, it is the payment for tax. Then that means whatever provision was made during the year, the same amount was paid as tax. So in our statement, what we do it is we deduct this tax from the cash which is generated from operating activities, that is 20,000 we deduct it, and our final amount that we will get will be the net cash generated from operating activities, that is 1,69,500. So this is our answer. I hope you have understood how we have calculated the cash flows from operating activities. Now the steps that were involved were, first of all, we found out the net profit before tax, then we adjusted the non-cash and non-operating items in the income statement, then we found out our operating profit. After that, we adjusted the current assets and the current liabilities, then we got the cash generated from operating activities before tax, then we deducted the tax that gave us the net cash generated from operating activities. So I hope you have understood. Thank you.